Welcome to this Carey webinar, brought to you with Morrow Sodali as part of the Guernsey Sustainable Finance Week. For those of you who not met me, my name is Rebecca Booth. I'm Client Director at Carey, and I'll be leading today's topic, ESG Investor Expectations. We have for you experts in their field. David Shammai, Cross-Border Corporate Governance Director at Morrow Sodali, and Mark Vidamore, Head of Funds at Carey. Mark, could you please introduce yourself?
Hi, Rebecca. As Rebecca said, I'm Mark Vidamore. I'm Head of Funds and a Director here at Carey. I've worked in the Guernsey financial services industry now for almost 30 years, with 25 years of those specifically within the Guernsey fund industry. An accountant by trade, I have focused on the administration of closed-ended alternative asset and listed funds during that 25-year period. In addition to my day-to-day administration role, I've also acted as a director of a number of funds whose investment focus is across the full spectrum of private equity, infrastructure, debt, real estate, and have also experienced specific jurisdictional and industry strategies. Carey is a Guernsey-owned and managed fiduciary and administration business, and we proudly count amongst our clients a full spectrum, including private wealth and family offices, unregulated corporate clients, as well as the regulated investment funds and their connected entities. Carey's now employed close on 60 staff in our St Peterborough office, and we've been in existence now for about 50 years. And this longevity would not have been possible without giving attention to our clients and their investors' requirements and how those changed over time. The concept of environmental, social and governance and responsible investment have been around for many years, and we're all aware the interest in these concepts has been gathering pace. This will, I'm sure, accelerate due to the general public reassessing their own personal expectations during the current COVID-19 pandemic, and this will feed into market demand for more responsible investment and focus on ESG matters. In addition, the requirements of global regulators on businesses, including the regulated fund industry, will require new products and services to be developed or existing ones to be enhanced. I strongly feel that Carey is well placed due to our partnership approach to servicing clients that will allow us to effectively and efficiently understand and work closely with our clients and specialists such as Morrow Sodali, develop what our clients, their investors and the regulators demand.
Thank you, Mark. And David, would you please introduce yourself?
Yes, thank you, Rebecca, and thank you, Carey, for inviting us to speak today. Morrow Sodali provides corporate board and executives with strategic advice and services relating to corporate governance, shareholder communication and engagement, capital markets intelligence, proxy solicitation, shareholder activism, and merger and acquisitions. Indeed, my personal focus is corporate governance. I have been in the area of corporate governance in various capacities on consulting and on in-house for 15 years now. Prior to joining Morrow Sodali, I have been with the governance team of APG Asset Management, which is the Dutch pension fund manager. So quite a lot of hands-on experience on how investors are looking at these issues of corporate governance and ESG when it comes to the voting policies, engagement with companies and other aspects where they're setting expectations to companies. And hopefully today we can have a discussion on ESG and how investor expectations are coming into that area.
That's great. Thank you, David. Now on to the important subject, which everyone is here for, the environmental, social and governance issues which have come to the fore in the funds industry. So David, on the subject of this webinar, what do you see as the top 4 expectations that investors have of boards in relation to ESG?
So that's an interesting one, really, because the area of ESG, and as we heard from Mark, as you put it, it sort of drives quite a lot of change and quite a lot of high level of complexity. But when it comes to investors' expectations, when we're looking at it at a very high level, actually things in my view are fairly simple. What investors expect is from boards and companies to consider material ESG risks, which is in other words, the impact that the external environment has on the operation of the companies. The second thing that they would like, they expect boards and management to do is to demonstrate that the board is considering the ESG impact of the company on the outside world. And that could be reputational, but it could be an upside opportunity in terms of how the company's activities have an impact on the outside world, on the society in which it operates, etc. The third sort of headline expectation, I would say, is that the company will provide clear and transparent reporting on these two areas. And the fourth thing is that the company demonstrates, that sort of closes the loop back for me, actually, as someone who comes from sort of corporate governance background, that a company will demonstrate that it has the right governance structure in place to support these issues. So I think that's sort of the nutshell of it. I mean, I would just add as a side comment that, you know, what I said now is true to mainstream the large international investors, but I would say that's true to whether they're approaching the investments in listed companies, but also private equity investment. The differences are not in the substance of what they're after. It's more in the mechanism and the leverage that they have and the access that they have to the activities of those companies.
Yeah, that does seem to be the way that ESG is going, that you do have boards, regardless of whether they're regulated or not, having the same and similar expectations from investors, not just institutional as well, but also the family office type investors as well. So Mark, at Carey, we obviously administer a number of different types of funds. What has Carey seen in relation to ESG fund questionnaires we receive from prospective investors?
Well, from the questionnaires we've seen, Rebecca, and kind of David gave a very clear list of things that the investors are looking to receive, but it's immediately obvious from the questionnaires that we have received that there is no industry standard towards the format, the questions that are being asked, or how the answers will be analysed. Further, it's very difficult from what we've seen so far to identify a consistent kind of standard for measurement, which is providing kind of difficulties when knowing how to answer a question. The questions certainly relate to the fund and the underlying investments, but we've also seen kind of the questions kind of being wider in terms of the fund manager and even the administrator and other service providers and their ESG thoughts as well. Specifically, the majority of the questions focus on how the fund manager manages the ESG issues related to the fund and its investments, and includes how the fund manager will monitor the ESG risks within the portfolio and how they will monitor those going forward. So it's not just an initial kind of look at the risks, but how we're going to deal with those going forward. And whether they kind of accepting those risks, transferring them, or mitigation. Therefore, from the administrator's perspective, working with the fund manager, responding to the questionnaires is quite inefficient, and it's actually quite a timely and costly exercise, which ultimately somebody will have to pay for those services.
That's true. So David, for these questionnaires, what advice could you give to fund managers and to boards as well on how they could complete them? And are there any reporting mechanisms which they might find helpful for this?
So I think, I mean, that's quite, and that's also what Mark is saying is very much mirroring our experience with that. I mean, at the moment, the topic is still at a sort of early stages in some respects, and therefore the consistency is still not there, which makes it quite tricky from a reporting perspective. I mean, what I would recommend is that, but that's sort of easier to be done at a sort of from a company's perspective, to look at the investors and to consider what is the approach of the investors, what are the pieces of information, what are the important points per investor. Now, a lot of that information, there's a lot of information out there because the investors are increasingly putting more and more information about how they are looking at ESG issues, but a lot of it is sort of at an asset manager, at a manager level, as opposed to a fund level, which requires a bit more analysis and a lot more granular look at that. So I would say first step, understand, look at the set of investors that are relevant to you, that you're most important, and look at what their approach is. The second thing I would say is there are some standards that are emerging as consensus. I think especially that's to do with the issue of climate change and sort of the E side of the ESG. So we're seeing things like the TCFD, which is emerging as a global standard, and a lot of the investors came out in support of it. It's an initiative, to those of you, it's an initiative that's coming out of the sort of the G20 FSB, therefore it's a global initiative, it applies in every market. So that emerges as one template for reporting. And in terms of more detailed templates for reporting, GRI has been in place for a while. Increasingly, we are seeing SASB, the Sustainability Accounting Board, also adopted by investors as that. So I would say, as a second step to companies, look at those emerging more consensus templates and perhaps use them as a starting point.
So going back to your point, to look at the set of investors, do a lot of the investors have their requirements for ESG actually on their websites, or are they approachable to be able to understand what they're looking for?
I think that's quite an interesting question, Rebecca. I would say. I mean, they do have information out there. They certainly, would not want to be contacted about information that's out there already. I guess it is. I think a lot of investors these days, they focus on the quality of the dialogue and the quality of engagement, and being quite sensitive to that. I mean, we're talking even, forget current circumstances aside. Generally speaking, we're talking about investors with very large portfolios, and they need to sort of deal with quite high number of companies. So, which is why they're putting that information out there, and so they're expecting companies and managers who are coming to them to be sort of informed at least at that level. I would say that is one thing. I mean, I'd say the other point is how to position what and sort of what sort of the objective, because ESG, as I said before, it's about understanding what the material issues for the company. Therefore, it's really, I think, the starting point will be for the company to articulate what is it that is material to its own business. Therefore, in many cases, we're seeing companies going to investors and say, well, could you tell us what you consider as material for us? That's probably not the best starting point for the discussion.
That's true. Thank you. So we've seen quite a lot in the press at the moment, and certainly there was an article in the FT on Saturday as well. And David and I, we've spoken about this. The EU has a consultation paper out at the moment. They are considering ESG disclosure regulation. UK is at the moment deciding whether to adopt it or not. If they do adopt it, then it comes in March 2021. That will be for non-EU members using private placement coming into the UK and the EU, obviously based on the UK's decision and implementation. That will put a lot of onus on fund managers and boards to understand the regulation around that. How best do you think the boards and fund managers can prepare for these requirements, David?
I think this is, we're talking about quite a broad set of measures, as you said. I think just to bear in mind that when we talk about these initiatives, they all sort of fall under this umbrella of measures that the European Commission has called the Sustainable Finance Plan, and we're talking about measures ranging from sustainable benchmarks and they're already going down the track of defining how these sustainable benchmarks will look like. We're talking about range of measures to do with the taxonomy and the sustainable taxonomy, which is having some sort of like a dictionary of activities that will fall under, that could be labeled green, what cannot be labeled green, exactly very detailed definitions of that. And the sort of third broad area are all the measures around transparency and disclosure of non-financial information, and that's something that applies to companies, but it also applies to financial services and to fund management and organizations. So a wide range of topics, and I guess how to approach that. I mean, I think the most important thing is to remember there's the issue of obviously compliance and whether things will come into force. And as you said, I mean, we don't know exactly about what will happen with the UK in that respect on some of these measures. But I think broadly speaking, what I would say to companies and to boards is sort of to take a step back perhaps, and remember that when it comes to sustainability, it is about them telling the story of the company and how the company creates value and what the company's impact on the environment is. So I would say try to sort of step back from these lots of details and lots of complexity of regulation, and try to avoid treating it as a sort of a compliance or a tick box exercise, and instead think, well, here is the opportunity to sort of tell the story of how are the businesses working and all the positive benefits that we have on the things around us.
Yeah, certainly. Almost in the same way that a board should approach a corporate governance code as well. This is what's expected of us, but let's step back and see how we can actually apply this so it works for our particular situation as well, I think. It will be interesting to see what disclosures will be needed on websites, what policies and procedures might need to be adopted and amended, any prospectus disclosures that are required. I think we are in the middle of a consultation with the EU at the moment. Consultation finishes in September, so I guess after that it's watch this space and see what's actually going to be needed on this.
I think that's right. I mean, the way that this is positioned until so far is that this is, rather than being, if you read the stuff that's coming out of the EU, they see it as another step along the way that started, way back in 2013 with a directive for non-financial information, and very much so this is just another step of crystallizing some stuff. Of course, when the things land on companies and lands on fund managers, suddenly they have to deal with a lot more compliance, but a lot of it should be comply and explain. So I mean, again, I'm sort of risking repeating myself here. I think the issue is for companies to consider what is relevant for them and how can they clearly comply, but really put the emphasis on their own story.
Mm-hmm. So there's obviously going to be a lot of opportunities for funds and boards that embrace ESG. What do you think those potential opportunities for those boards that do embrace ESG mindset might be?
I think that's actually, thank you for raising that point, because there's a sometimes tendency to think about the sort of the downside of ESG and the additional burden perhaps that puts, but actually there's quite a lot of opportunity here. I would say in ascending order of how important that is. I mean, to start with, this is an opportunity for the company to tell a story, and to tell a story to a wider group than just the investors. I mean, this is where sort of, primarily the audience there when it comes to governance is company secretariat, and it's perhaps more legal. This is a wider story. This is something that the IR team will have to be involved in as well. So I think that's one upside opportunity. The second upside opportunity is that it will allow companies increasingly to access more long-term capital. And we know we started by saying how we're seeing more specific products to do with sustainability that are targeting sustainable money. This will open these pools of capital, or will open more pools of capital for companies that get it right. I mean, I would say that. I would also say that actually more than that, even mainstream capital that is not targeted necessarily on sustainable investments will companies may find that it's more difficult for these managers to own stock unless the companies can demonstrate that level of performance. So access to capital clearly is a huge win. And I would say the third opportunity, and that's really depending on sort of the level of progress that the company has. And I'm sure a lot of companies that have thought through these issues already, because the things that are operationally important, companies and boards have thought about it already. I mean, if it's operationally important to the business, of course, a board will sit and think about it. But perhaps that sort of way of thinking that actually here, my investors, the people who provide me capital, whether shares or debt, they also care about those things. So here are some activities that maybe I can go into and benefit from from better perception of my investors. So I think there's actually possibility here to actually get it to find new business opportunities within the company. That's actually quite a potential win as well.
Okay, that's three very interesting points there. The opportunity to tell the story, I think, is a very important one when you're looking at the new generation of investors coming in. You have millennials, you have people who have this at the fore of their decision making, and if companies can harness that capital, like you say, then there's an opportunity for long-term sustainability of their own business, as well as those investments in which they go into.
Yep.
So just for those people listening, before I move on to my final question for our panelists, can I remind you that we've got a Q&A live event section on your link. You'll see it up on your screen. If you click on that and come through with any questions, I'll answer them through to our panelists once they come through. And please do ask questions. I'm sure they'll be more than happy to answer them. So my final question is for Mark. What role do you see administrators playing in supporting boards with ESG?
Thank you, Rebecca. As I said before, I mean, part of the questionnaires that we're seeing is questions about how not only the fund manager and the fund are dealing with ESG matters, but also how the administrator and the service providers are as well. And certainly the first thing that we are always very mindful of is our own ESG matters and how we deal with them, so that we can report those through on those questionnaires as well. Secondly, we're keeping ourselves aware of the latest ESG developments, including kind of the changes to regulation, good industry practice, and where possible, where we can find out what investor expectation is, including kind of conversations with David and his peers. And we use that knowledge and experience to help guide the fund boards in conjunction with the fund manager. We'll also be engaging with our full network, which includes kind of, as I said, the specialists such as Morrow Sodali, the audit and advisory firms, legal advisors, to kind of develop practical solutions for our clients. And we'll certainly work very closely in partnership with them, as we do as a standard, to help the boards understand the requirements, but also to develop an efficient reporting process to the investors as part of that as well.
Yeah, and I think also, just to add to that having the same culture as fund managers, as boards, which fall into this growing ESG mindset is really important as well, to make sure that everyone's moving in the same direction and wanting to achieve the same goals, and administrators play a part in that, as do service providers. And one can assume that in the future we'll be seeing much more questionnaires coming through as new business as well. How do administrators apply ESG? Can we work with you? So I can see that becoming a future movement in this area as well. So, do we have any questions? No questions. Okay, well that's good. That makes it seem like we've covered everything that everybody would have wanted to have got from this webinar. So that's good to hear. So I think what we need to do then is just to wrap up. David, do you have one takeaway point that you have for our attendees?
I'd say sort of one point, in case it hasn't made it already, is just need to fully appreciate how important this development of mainstream investors and investors generally looking at ESG much more proactively, and Mark, echoing both what you said about working with on all sides of it, and Rebecca, what you said about working together. This is a lot more about governance. When we started talking about governance, this was about investors saying to companies, to boards, well, we want to make sure that the decision-making processes are done in a particular way. It sounds a bit dry if you're outside, and why would we do that? We do that to make sure that the decisions are being made in an optimal way to create shareholder values. Here we're talking about something that's a lot more radical. Here we're talking about investors actually saying to companies, we are now want to talk about your business. We want to understand how your model is, how and why you're doing the business the way you do, bearing in mind your impact on the outside world. So the thinking behind it and the implications are a lot more rooted in the business.
Actually, what you've just said, David, feeds into a question that's just come in now about how ESG can actually go beyond GDP and into growth measurements which look at welfare economics, circular economy, and looking at the well-being as a whole. Could you comment on that and how you feel any further about that?
I think it's a very good question. I think what we've been seeing in the last 2 months is that ESG is an evolving matter. There's been a lot of talk about how this materiality that I mentioned is not set in stone, and it's something that is dynamically evolving. And what we've seen in the last few months is how the impact of companies on the society where they live. I think the issue of responsible, all sorts of issues around employees, health and safety, etc. This is going to go up in importance. So I think that's very much where things are heading.
And we also have one other question that's come in. What are the thoughts about the role of the growing number of rating agencies? This is always a hot topic with boards. For anybody who's sat in a board meeting and there's been discussion on rating agencies. David, would you like to comment on that as well?
Yeah, I think that is. I can see that's. We know that from clients that are looking at all these ratings and sometimes exacerbating about how come and understanding what the difference between the rating and understanding where the gaps but really what I think it should go back to is understand what your investors are doing with these ratings. And on that as well, there is a lot of information. So, looking at my investors, how are they going to look into this? Therefore, maybe there are some ratings that are more relevant or more important than others. I think with time, hopefully, I think we will see some more simplification of that. And I've actually seen an interesting note coming out of Norges, the Norwegian Sovereign Wealth Fund, about sustainable reporting, where they predicted that actually as things mature, we're probably not going to need a lot of that information. The only information that will be relevant is the stuff that's coming from the company and is available on its website. But this is aspirational. I think this is where we're hopefully heading. At the moment, where there are lots of perspectives out there, the message is understand what your investors are using, how they're making use of it, and therefore, I think engage also with these rating providers to explain your activities.
Thank you, David. Mark, did you have any final takeaway points for our listeners?
Thank you, Rebecca. Yes, as David says, we are certainly this is developing at pace, and I think everybody is certainly learning as we go along. We're certainly keeping a very good eye on industry standards and working with our clients and with specialists to provide the service that's expected from the investors. All I can say is that please kind of deal with or contact ourselves here at Carey, or kind of Morrow Sodali as the experts, as David has proved, to take this forward.
That's great. Well, thank you very much to David and Mark. Your insights into ESG and investor expectations have been really interesting, and it's been a really good discussion. I hope everyone listening has found this informative. Do get in touch if you have any questions. Our email addresses will be up on Eventbrite after this event is finished. If you've got any questions, do come through to us. Thank you very much, everyone. Goodbye.
Thank you.